Good evening, everyone. We continue our lecture on financial management. We are in the second topic, or the second chapter. We will discuss the financial statements, taxes and cash flow, in that order. Let us continue. We will skip this slide. We'll look at the key concepts, but then we'll look at this in the outline. We'll look at the outline here, the chapter outline. By looking at the chapter outline, we can see that there are basically 5 key points, or key concepts that we will look at in this chapter. The first is the balance sheet. This is the first financial statement. The first 2 points are about the financial statements. The first type of financial statement is balance sheet. And the second one is income statement. This is the second financial statement. This is called the income statement. Then we will compare cash flow and accounting income. We look at accounting income and we will see some disadvantages or limitations of accounting income, and we will see that this cash flow measure is a better measure. So we'll be picking up on cash flow after this. So our main measure would be cash flow. So that is looked at in the third key point. Then we will look at taxes. Tax that is paid by businesses. And we will look at the concept of marginal tax versus average tax in taxes. So that will be the fourth key point. And the final key point, we will look at cash flow. Remember the third key point here? We picked up on cash flow, and this is developed further in the fifth key point. How do we derive this cash flow statement? Or deriving the cash flow. The book doesn't use this statement precisely, but we can present this in the form of a statement. Therefore, we look at that in the fifth part, or the fifth key point or key concept in this chapter. So therefore, there are 5 key concepts in total. So balance sheet. In balance sheet, there are many things that we will look at, but one important aspect of the balance sheet is looking at the market value versus the book value of balance sheet. We'll be comparing the two. Let's move on. Alright, we look at the balance sheet. This is the key, first key point, or key concept. So the balance sheet is actually a snapshot of the firm's assets and liabilities at a given point in time. So there are some keywords here. First, it is a snapshot. So it's like taking a photo. It's like a photo. A snapshot. And this goes together with at a given point in time. At a particular specific point in time, at a moment. And what does it give you? What picture does it give you? It gives you a picture at a particular time. But what does it give you? It gives you the company's assets or the firm's. It can be any firm, can be any business. It can be a sole proprietorship, partnership, or a company. It gives the business's assets and liabilities at a given point in time. So this is very important to understand. Then when we come to income statement, then it is a slightly different concept compared to balance sheet. So remember this. It's a snapshot, meaning it gives a point or a picture at a particular time. A photo, if you like, at a particular time. Alright, now assets are listed in order of decreasing liquidity in the balance sheet. Now we come to the format of the balance sheet. How is the balance sheet structured? So before that, we look at what is meant by assets. Assets is what the firm owns. Remember, it's the firm's assets. So what are assets? Assets are anything that the firm owns. The firm has right over those things. So these are assets. These are called assets. And we look at various types of assets that are stated in a balance sheet. Yeah, we'll come to that a bit later. Now, what about liabilities? Yeah, it gives you assets and liabilities. Okay, but also, yeah, it does not only give the liabilities, it also gives the remainder. Yeah, we'll look at that a bit later. But in very simple terms, it says assets and liabilities. Yeah, but actually it gives you assets, liabilities, and equity. Okay, a firm also has equity. Yeah, so there are three forms, if you like, yeah, or three components in a balance sheet. Yeah. So the second component is the first component, assets. Okay, this is what the firm owns. The second aspect will be liabilities. Yeah, what the firm owes. Note this. Yeah, this is owes. This is own. Yeah, this is what the company owns. Okay, this is what the company owes. Yeah, what the firm owes. Yeah, that means it has to pay. It's an obligation. Yeah. Okay, this is what the firm needs to pay. Why does it need to pay? Because these liabilities are funds that the firm obtains in order to purchase these assets. Okay, and therefore, these are liabilities or obligations that the firm needs to repay. Yeah, that is why it's called liabilities. Yeah. Okay, apart from this, you also have equity, which is not stated here. Equity is also the third component, yeah, third and final component of a balance sheet. Okay, this gives you what the owner, yeah, has put into the firm. Okay, so that is the investment by the owner of the firm, yeah, in that firm. Okay, that is equity, yeah. All right. Now, assets in balance sheet are listed in order of decreasing liquidity. Yeah, this applies also to liabilities, yeah? Not only assets. Yeah, both assets and liabilities in a balance sheet in a conventional form. Yeah, in a conventional structure. Traditionally, assets are listed in this order. Okay, that means the most liquid, yeah, on top, and then the least liquid, yeah, the not so liquid, yeah, assets will be at the bottom of the balance sheet. Yeah, what do we mean by liquidity? Okay, there are two aspects, yeah, to liquidity. One is it is liquid if you can convert the asset to cash easily. Okay, easily means quickly. All right, that's one. And the other aspect is you should not have to lose value in that asset. Yeah. For example, these two aspects must come together, then only it is liquid. Yeah. For example, if you purchase an asset, yeah, now the value of the asset now is 2 million. Yeah, let's say you purchase a piece of machinery. Yeah, it is worth the cost is 2 million. You just bought it a few weeks ago, for example. Now you want to sell it. Yeah, you are forced to sell because of some difficulty. Okay, so if you can sell it without losing value, now that means you can sell it at, let's say, 2 million. You can convert this to cash very quickly, then it is a liquid asset. Okay, but let's say you want to sell it. Yeah, you cannot sell it very quickly. Okay, and you have to sell it at a lower price. For example, yeah, if you want to sell the same machine and you are desperate for funds now, okay, if you want to sell it at all costs, then what you can do, you can reduce the price. Yeah, the cost is 2 million. If you want to sell it off very quickly, you can sell it at 1.5 million. Yeah, you reduce, you discount. Yeah, we call this discount. We'll pick up this word again. Yeah, discount later. It's a very widely used term. Yeah, in FM. Okay, so you discount the machinery you discount it, yeah, to 1.5 million rather than 2 million. Then you can sell it quickly. Yeah, so you can quickly convert to cash, but you lose value. Okay, so the important thing is not to lose value. Yeah, you can quickly convert to cash, but you should not lose value. The other way, if you're not so desperate for cash, what you can do, you can hold on to the asset. Yeah, you wait until the price is significant. Yeah, for example, the 2 million machinery you can sell at 2 million, but you'll have to look for the right buyer. Yeah, so it's not so easy to convert. You have to wait. So if you have to wait and you don't lose value, it is still not liquid because you have to wait. Is that okay? So an asset liquidity, yeah, assets liquidity is measured by both these dimensions. Yeah, it must be quick. Yeah, easy here means quick. Yeah, you must be able to quickly convert this to cash. That means you can convert, you sell the asset, so you get cash. Yeah, that is what we mean by conversion to cash. Okay, and at the same time, you should not lose value. Yeah, you should be able to sell at about the same price. Of course, there will be some loss of value. Okay, you would not normally be able to sell an asset at the same price at which you bought the asset. Yeah, there will be some value loss. Yeah, but if this value loss is very significant, then the asset is not very liquid. Is that okay? So that is how the assets are ordered. Yeah? So you need to be clear about liquidity, yeah? The concept of liquidity. Alright, now then there is an important identity. Yeah? This is like an equation. We call this the balance sheet identity. So this gives form, yeah, or structure to the balance sheet. Yeah? So here, it is a very popular term. Assets is equals to liabilities plus stockholders' equity. So you have all the three components here. 1, 2, and 3. Yeah, 3 components of a balance sheet. The assets, what the firm owns, okay, owns, yeah, here, must be equal to what the firm owes plus what the owners of the firm have put into the firm. Alright, this must always be true. Yeah, this is called the balance sheet identity. Alright, so note that, yeah, let's say the stockholders or the owners, yeah, put in 1 million, yeah, and the company or the firm borrows another 2 million, yeah, so in total 3 million. And this 3 million that the company has collected both from the owners and from the creditors. Yeah, these liabilities are provided by creditors, yeah, roughly. So these creditors and owners funds are used to purchase $3 million or ringgits of assets. Okay, so this must be equal, yeah, at all times. This identity, yeah, must remain true. Is that okay? Alright, yeah, let's move on. Now this is the balance sheet structure, yeah. This is how the conventional balance sheet is structured. Okay, so on the left hand side you have assets, yeah, and on the right hand side you have the liabilities on top because it is more liquid. Remember, liquid here for liabilities means not that it's converted to cash, but it is repaid earlier. Yeah, the earlier a liability is repaid, it will be on top. The later the liability is repaid, okay, it will be at the bottom. Yeah, at the very bottom here will be equity. Yeah, what the owners have put in, yeah, because what the owners invest in the firm will not be repaid. Yeah, okay, will not be repaid. There's no intent, yeah, to repay the owners. Yeah, there will be compensation to the owners. Okay, they will be paid dividends, but there's no intent, yeah, or goal of repaying, yeah, the owners. Yeah, and the same thing on the assets portion. Yeah, this assets portion, the most liquid will be stated on top. This will be current assets. These current assets are assets that are converted to cash within 1 year. Remember the arbitrary demarcation line. Yeah, if it is the asset is converted to cash within 1 year, it's called current. Okay, current assets. And if the assets are not converted to cash, yeah, within 1 year, then these are called fixed assets. So this is at the bottom. Yeah, the current assets are more liquid. The fixed assets are less liquid, yeah, or more illiquid. Yeah, illiquid. Yeah. Therefore, fixed assets are made up of 2 types of assets. One is called tangible fixed assets. Okay, for example, land, building, yeah, and all that will come under tangible, yeah, meaning you can feel. Tangible, you can feel physically, yeah, there's a physical presence. And intangible are physically not present assets, yeah. For example, it can be goodwill, patent, copyright, all that, yeah, will be intangible assets. So that is the structure of the balance sheet, yeah. Okay, this is current assets. We need to understand, yeah, the structure of the current the balance sheet. Yeah. Okay, then the current assets minus the current liabilities, the difference between the two. Okay, remember this, yeah, this will be current assets